Thank you very much, Marty. My name is Matthew Kessler. I'm with Partners Equity Capital. It's good to be here today. I've got four incredible presenters today, all with decades worth of commercial real estate experience. Just to set the table, things that are going on in the marketplace. Actually, I cannot see San Ing. So, San, you are not in the picture. Just to
There he
set the
is.
table, we need to sort of think about how inflation and costs are really impacting commercial real estate. WTI today, that's West Texas Intermediate Crude, is at 86. We've got the 10-year Treasury at 3.3. That's where all capital is placed in terms of starting a mortgage or a lending or a recaps. That's usually your floor. Dow and NASDAQ down 20%. Bitcoin down 60. And inflation has come down from summer highs. You've got gasoline prices across the country have come down from 6 to 350, and then housing prices uniquely are coming down not only in California but across the country from their highs of January. So just to set that table, we want to then focus really today on real estate and hard assets. We've got four great speakers, so I'm just going to quickly introduce them in terms of just a bio, and then I'll start with some Q&A. On my left, I see San Ing. He's the managing partner of Skytian Capital in New York City. He's invested about 650 million across the globe in multiple asset classes. Grew up in New York City. To my right on the screen, I've got William Lobel. William is the founder and managing partner of Distressed Capital Resources. Bill is, as I like to call him, a lawyer's lawyer. He's a Chapter 11 bankruptcy expert. And in September, he was recognized in the Best Lawyers edition of one of the best bankruptcy, creditor, debtor rights, and insolvency reorganization lawyers in the country. Congratulations. At the panel that I can see also, I've got obviously Kamil Homsi. Kamil is the CEO and global head of Global Realty Capital in New York City with his own family office and also works out of Dubai. He's a single family office and he has an extensive background in microeconomics. And I think we're going to hear that today. And lucky for him, he has two sons that are lawyers. And then obviously, Dino, what's nice to see you. And then Dino is Christoforakis is the founder and managing principal of Vential Investments. What's interesting about him is that New York City based real estate, private equity. He too, like Bill, was featured in a magazine recently for Globe Street Real Estate for those that are a unique group that are 50 individuals, 40 and under. And obviously for him, I like that we're going to talk a lot about ESG, which is environmental, social, and governance. So we're going to cover a lot of really good ground today. So Dino, since I ended with you, I'm going to start with you. So a quick question for you and your firm. You've mentioned a few times that multifamily is on fire, that single family rentals are doing amazing, that built to rent space and co-living is really strong. Love you to talk about that, and please give a little more in-depth intro on your firm.
Sure. Thank you so much, Matthew. Pleasure to be here. My name is Dino Christoforakis. I'm the managing principal of Vential Investments. Vential is a private equity real estate company that I started here in New York early this year after a 17-year career on the principal side, working for large institutions here in the US and Europe. The genesis behind the Vential idea was that if you're a family office and you're looking to find solid real estate opportunities, you got to look for a needle in the haystack. And on the flip side, if you're a good manager, a good operator, good developer, or emerging manager more so, and you're looking for access to capital and long-term capital, you have a long way to go before you get through a lot of the expensive capital out there first. A lot of those institutions that I used to work for and I've crossed paths in my career, they would see those smaller deals and they would end up passing or not even going through their entry-level analysts for a number of reasons. So what we do at Vential, we create those co-investment opportunities for those family offices that they're looking to diversify their holdings into real estate. They're looking to generate alpha with strong local operators that have a unique strategy, a unique business plan, solid track record, and good reputation.
So, Dino,
So
talk to us a little bit about why you believe multifamily is on fire. Talk about the rentals that you like, why this built to rent space is great, and then co-living, which we discussed throughout our last couple talks. Why don't you hit on that for us?
sure, and I'm sure Sam is going to jump in here right after me on the residential side. But everything residential in the United States, the fundamentals are on fire, right? So we're not nearly building enough housing, whether it's single or multifamily, as we need in the United States, right? There is a huge housing pandemic, so to speak, and more so on the affordable side of the equation, right? And workforce housing as well. So we are firm believers on the multifamily space. There's a huge runway ahead of it. There is the BTR space, the build to rent, which is single family rental, purpose built communities. That we see a lot of institutional attention and capital flowing into that space over the past couple of years for a number of reasons we can talk about, and of course on anything else that's related to residential, whether it's mobile housing or co-living. Happy to touch on that too.
Terrific. So let me go over to Bill because I think Bill's got an amazing space that he covers. Bill, being a Chapter 11 bankruptcy lawyer and a lawyer's lawyer and distressed capital, it's so important that you have, told us many times as we've gotten together over the past few days that every real estate, sponsor should already have in his pocket or either on retainer and know somebody to talk to before he's in trouble. So if you would just position yourself and your firm, and I've got a couple questions for you, so please go right ahead.
Sure. I've been a Chapter 11 lawyer for decades. I've watched the system evolve, and I can tell you this. There's nothing worse than a Chapter 11, while sometimes there's nothing better than a Chapter 11. But generally, the rates are so high these days. Even out in California, our rates are approaching $2,000 an hour. They're higher than that in New York and DC. And the system is so complex, so difficult, and it is so unpredictable that if you can avoid the 11, you do. So what I did is I sat around one day and said, what can you do to have a better chance of avoiding an 11? And I took 50 years of relationships and experiences, and I put together what I call a toolbox. It's all the tools that you would use to try to avoid the Chapter 11. And so, it always starts with new financing. It goes to equity investment. It goes to financial advisors, all the things that we're used to. What I've done is created an umbrella that gives access to more of those than I think you'll find anywhere else in the country. When somebody comes to me, I charge them a little retainer, $10,000. I give them a SMART plan, which is a roadmap. It tells them how they go through the steps to stay out of the Chapter 11 and what tools they use. I've entered into agreements with those people who supply to pay a commission when I refer somebody to them, but they can't charge somebody more because they're giving me the commission and it's fully disclosed. So for a very small check, somebody with a big problem can have access to more tools, a wider toolbox than you'll find anywhere else in the country. So my hope is that I'll avoid the Chapter 11s for them.
Right. And when we were all together, you really dug into the toolbox. Open that up for us. Give us an example of like what could a client expect once he's paid his retainer with you? What does that toolbox offer him in commercial real estate?
Well, look, the first thing is you always try to negotiate with your existing lender. By the time they get to me, they probably lied to their lender so many times that they can't get that deal done. If they can, it's great. If they can't, I have sources all over the country to match particular types of lenders with particular types of situations to maximize the chance that they will lend. And they're all people who will lend into distress. That's why they're in my toolbox. After that, I have a cadre of people who will fund equity, either for joint ventures, buy distress on a distressed basis, otherwise. I have sources for short-term capital, people that have big life insurance policies. I'll send them to Melville or somewhere where they can liquidate the insurance policy. I have somebody who lends only on high luxury goods. So if you've got an extra Lamborghini, airplane, painting, whatever, you can make loans on that. So I've just taken all the various things that you use, made deals with all the financial advisors, and I guide the client through that, always with the goal of avoiding the Chapter 11.
Thank you very much. So I'm going to glide over to Kamil Homsi. Kamil is the CEO of Global Realty Capital in New York. So welcome. Nice to see you. You told me before that, you invest in multiple areas in the world, Asia, London, Amsterdam, US. So I want to hear about that. And then, prior to hearing about that, tell us a little bit more about your firm, please.
Thank you, Matt. Good to see you. Good to see everyone. Kamil Homsi, GRC Investment Group. We are a single family office located in Dubai, and we are now in our fourth generation. The assets in Europe go back to beginning of 1957, where our grandfathers under the direction of English wealth managers started purchasing office buildings downtown London in the business district. And today, there are very few properties down there that we do not own, us and other families and other colleagues who are not organized as family offices from the Persian Gulf. The GRC Investment Group has a global mandate, and that's where, since I took over years ago, I realigned the ownership that we have of different assets, and basically in buying out many of the smaller investors that were placed with us on those assets by the direction of the European wealth managers. And that caused many wealth managers to be really let go. I don't want to say fired, as if I did not say it right now, but many of them bent out of shape, but that was the only way to bring our assets to efficiency. I can comfortably say that I have, during the years, closed deals in every continent. It is easy to close deals in the largest continent of the world, Asia, but also Australia included, Europe, East and West, United States, North and South. Africa was always on our map, especially when we invest into PPP projects, taking assignments in partnership with the IMF and the World Bank.
So let me ask you a question. So what are your top two locations now that you and your group and your family office are investing in? Where is that?
I mean, honestly, if I would choose any other location beside the United States and its market today, I will be just being diplomatically correct. And I'm not diplomatically correct. So, I mean, if an investor tell me today he want to invest in Europe, I mean, look where Europe is. Not only indebted, but it is drowned in debt, but also into the situation that they're living today, and also the shortage of supply that they have. United States today is having
Europe. So Europe is a good place?
I'm waiting for opportunities in Europe.
Okay,
but
so what are the two locations? What do you like?
On direct investments, I will say the United States.
Okay.
And then my second is really our own region, because if you want to make money, the money is there. I mean, here people talk about internal rate of return, 18, 20, 24% is something that is going to make me rich. You want to get rich, go invest over there. But the risk is different. United States has a myriad to offer of opportunities, and also the fact that it is a stable country, stable government. Their currency is the currency of the world. It's not only the reserve currency of the world. It's the only currency today of the world. Look where the euro is standing today, 99 cents.
Nice.
I just have one,
Nice.
I have one question for Kamil.
Sure.
So Kamil, when people talk about investing in the other areas, should there be like a risk premium and a liquidity premium for, like, if I'm going to invest in Europe, should I only be in there for 3 years? If I'm going to be in there for longer, should I expect a lot more return? Denomination of capital. Can you talk about that a little bit?
Absolutely. The risk that is always tagged to the investment varies from one country to the other. And in Europe today, you still have, among the 27 countries of the European Union, there are still 4 countries that offer negative interest rates. Imagine going to someone's house, invited, saying to you, bring the burgers with you. That's exactly how I describe a negative interest rate. So, and then the inflation, that the leading economy of of Europe, I mean, you take them in order. It's Germany, it's England, it's France, and then Holland. I mean, they are today feeling the pain of inflation. People are paying double for the food in England.
Right.
And
But
if you,
let's stick
if,
to let's
you
stick
know,
really to commercial real
but
estate. How does that translate to real estate?
adding to the question from Marty, beside Europe, you have also emerging market. Many investors from the West, they are told, go invest in emerging market. Emerging market, you might make a higher return, but the risk there is 3 times more than investing into developed countries like the United States and the like. That's
Okay,
where,
so if I'm a pension fund or I'm a family office that's in the room today or watching, I get fired if I take extra risk. I get fired if the investment that I put my, shareholders' money in or my family office money in, I got let go. But if I take the easy way out and say, you know what, US is a little safer right now. I'm not interested in, cap rates of, 15, 16%. I'm looking for something a little lighter. I think US then says, okay, I'm not going to get fired. So there's really something I think everybody in the room needs to think about is where's the risk and where do you take it on? So with that, let me switch over to San Ng. San, you're the managing director and managing partner of your own family office, Skytian Capital. I think what's interesting about what you're doing is that previously, so I think this experience that you bring to the table is immense, is that you put out over $650 million across the globe, which means you really have a nice appetite and understand the world, including the US, and you live in the US and you were born here. Today, you currently have $100 million that you've raised so far in $1 billion undertaking of your new fund. So talk a little bit about your firm, and then I have a question I'd like to ask you about, the capital markets today and commercial real estate.
Great. Thank you, Matthew, for inviting me here. So I'll give a quick background. I call myself an investorpreneur. That leads to why multifamily. So version 1 is entrepreneur, raising about 9 figures in a number of companies. Version 2, managing 10 figures of private equity and venture capital money. Then at age 45, took 5 years sabbatical. You might call it a midlife crisis. And in 5 years, really did a lot of deep thinking, research, even wrote a book on investing that, proud to say, went to a Wall Street Journal bestseller, but have since then followed a lot of the principles in this book to invest currently under the Skytian banner. And for the book's research and also from previous work, have convinced myself to go all in on multifamily. So currently we have 2 platforms. With Skytian, we're doing smaller deals, 10, 20, $30 million deals in multi, a lot in Florida. And we have another platform called MSC Capital that with my partners, we have about 5,000 doors currently under management. And those are going after larger deals, $50, $100 million deals.
So, with that, it sounds like you obviously got that really nice experience background, and I think everybody here has decades of experience under their belt. Talk about this co-living St. Petersburg, Florida. I mean, you talked about that you had 40 units, housing startups offering affordable housing and homes, adult roommates, it's informal, it's co-ops, it's co-housing. How does, co-living really work, and why are you doing this in St. Pete? What is it about St. Pete you like?
Sure. So in the past 2 years, because I got bored in COVID, couldn't travel, I ended up just driving all over the country. I actually drove about 55,000 miles in the Tesla, because I love that car, and really seeing a lot of markets, and fell in love with the Tampa market as an MSA. And really the past 2-3 years went after a lot. We must have underwritten hundreds of deals, probably best and final in dozens of deals. We're closing our 7th multifamily now in Tampa. And what we found is the larger the deal, the more institutional grade, 30, 40, 50, 100, the harder it is to get. You get 20, 30 bids. So it's basically, you bend over and you basically tell the seller you want to pay whatever he wants. So we, despite that, we're able to close larger traditional multi deals. What we found also, Matthew, to answer your question, is that in the smaller space, $5, $10 million deals, we are the whale, right? We're not up against Blackstone or the larger family offices. However, they're too small to justify the time if we just kept it long term. So we're now working on a third building in downtown St. Pete, where we're taking a small asset that's unfurnished long-term, and we're converting them to what we call branded furnished flex leasing.
Nice.
Kind of a mouthful,
Nice.
but it's a blending of catering to megatrend of more affordable housing, millennials wanting to share, co-working, digital nomading. So essentially, as an example, if you took a studio in downtown St. Pete, unfurnished 12 months, it might be $1,500. We furnish it, make it beautiful. We can then rent it month to month to a traveling nurse, a nomad, or a work from home, and we can charge easily $2,500. We combine that with ADRs from Airbnb, and we can charge north of $3,000, maybe even $4,000 a month. Obviously, OpEx goes up, but not as quick as the income. So we now have a third building under contract to essentially do this flex leasing project.
So let me move over to Dino. Dino, we're at the 2-year mark of the pandemic, maybe even a little bit farther. You know, I think when you're at this mark, talk to me about, because you're in the private equity space as well for commercial real estate, how has the deal environment really changed since we're now at the 2-year mark of the pandemic? And then obviously I want to go right after that to Bill to talk about what you see on the distress side. So Dino, lead us off on where we are. We're at the 2-year mark of the pandemic. How has the deal environment changed for private equity for commercial real estate?
Sure. So the market is shifting constantly, right? And one of the things we do at Vential is we keep our pulse on the market on a weekly or daily basis, right? To identify those opportunities to generate alpha. So for example, if you ask me what's a good deal, 3-4 months ago, I would tell you probably development. Nowadays, with interest rates moving, the way they are, it's probably not as much of a safe haven as it was, a few months back, right? So asset class wise, risk wise, we are very opportunistic, also geography wise. So we're looking at deals and operators that they have a very unique strategy, and they're building a very unique product with a very unique way to help us generate that alpha for our investors, right? So it's an exercise that we were constantly going through to answer the same question. I think there are certain asset classes that the knife has been falling for quite some time,
Right.
and we see those steep decreases on values. Like for example, in the previous panel with Tim, we heard about shopping malls, right? That's a basis play. He was talking about an asset that was valued, that the current owner is owning, has it on their books for 265 million, and they're buying it for 65 million, right? So that's essentially a land play. It's a covered land play, right? And you have multiple exits. So similarly, because of the COVID dislocation, we have to see that market dynamic getting to a certain point where you can justify that cap rate expansion, right? To really pencil out the exercise of retrofitting certain asset classes into different use, for example.
So let me interrupt you and then go over to Bill. So Bill, let's talk about this. So we're now coming out of COVID. We've had amazing distress. We've had a lot of landlords leave their keys on the floor. We had a lot of people that are just hanging on. We've got generation 2 or 3 of families that said, okay, we're just not going to stay in this real estate business anymore. We're selling because we've never really liked it anyway. That was dad's thing. What are you starting to see in terms of, companies breaking, people just about to enter Chapter 11? What's taking place right now? So give us a good feel for what's going on in the environment.
It's interesting. Probably 6 or 8 months ago, I wrote an article. It was in Kiplinger, and it dealt with why the economy wasn't performing the way we knew the economy really was. And I interviewed a lot of people about that. And one of my conclusions was I interviewed a lot of bankers. And the bankers said that the federal regulators are not, at least them, were not forcing banks to deal with defaulted loans. And you give a banker a chance to kick the can down the road so the loan goes bad on somebody else's watch, 100% of the time they're going to do it. So what we were seeing is a lot of commercial loans accruing at default rates not being dealt with. It's for sure, it'd be the Republicans if they were in power, but the party that's in power is going to make sure that nothing bad happens between now and the midterms. You know, they've had a hard time. They tried at first to say, well, we really don't have a lot of inflation. Inflation went to 7, 8, 9. Okay, when the Fed first did their first rate increase, I said it was a joke. Now they're talking about maybe going up 3/4 of a point, and we have a lot more to go than that. But I think we're going to see, and most people in the business think we're going to see, what I call a tsunami of bad real estate hit in the spring or in the summer of next year. It's not going to happen before November. It probably isn't going to happen over Christmas, but we're going to see it, and we're going to see it in a very big way. One statistic, by the way, I didn't check this out, but I should have. A bankruptcy judge in Santa Ana told me, he said, Bill, how many Chapter 11s were filed in the Delaware Bankruptcy Court in January of this year? I said, I don't know how many. 111 in Delaware in January of this year. We've got a lot of big ones coming, especially in retail. We know it, but the economy has just held up. It started with all the trillions of dollars that went out for unemployment wages and PPP and all that kind of stuff. Okay. We've probably seen the last of those. The Democrats had to pass the last one, unbelievably called the anti-inflation bill, when it's clearly inflationary, but they had to pass it in case they don't win the midterms because they had to get the agenda done. So we got yet another shot of inflation hitting us. I think inflation is going to be a lot bigger. When I hear that inflation is dropping a little bit, maybe for right now, but we are going to see a lot higher inflation before we see a lot lower inflation.
All right,
And when that happens, Feds are going to deal with it.
I totally agree with you. And Kamil, I'm just going to ask you to pick up on that thread. So talk to us a little bit about inflation and interest rates on commercial real estate sectors. And most importantly, I know, we're all thinking industrial and multifamily. Well, talk to us about inflation and interest rates on commercial real estate. What are you seeing out there, and what are your investors seeing?
Matthew, I'm very happy to hear a man from California agreeing with what I am about to say in advance. Bill, thank you very much. I have an optimistic nature about myself on everything I do from the moment I wake up. And what I said before, that I am, bullish on investing in the United States, I meant it from the heart. And that has been my practice since 2010. But today I see the volatility from something different from what most of my colleagues, to my next, both my friends and also the people that I do business with. I look at the real estate today from the lens of the lender. If you remember, since Dodd-Frank enforced the question of ability to repay. Today, I see lenders looking into the borrower and also his or her tenants' ability to sustain their business and to be in business. And that's something that I don't hear about people talking. It's like, I remember in the late July of 2020, a private lender here in New York offered me 5 notes of office buildings that are in Midtown Manhattan, and I bought 2 of them, definitely at a discount. And with all honesty, and I can bring those people to the public and tell them the same. I walked into their offices. I said, don't turn your keys in. Let's reevaluate your property on a mark-to-market standards, and I will give you a capital injection and be your partner on the new valuation. Man was too proud. And to be specific, on 48th Street. I said, you are out of your mind. Oh, you are evaluating my property $80 million below what a broker from XY company, brokerage company told me. I said, brokers are brokers are brokers. At the end of the day, they get paid at the closing table. And to stay on point, Matthew, as you always want, which I appreciate, the interest rate is going to impact real estate big way. Now, United States is not one color real estate market. There are markets in the United States that never recovered since 2009. And then you have those who are lucky enough. One is called Texas, one is called Florida, and one is called Idaho and Arizona, where people from certain states, I don't want to call them democratic states, I didn't say that, and they moved down there because there was no COVID there. No, there was COVID there. There were taxes, there were social unrest, and there were other reasons that made people move. So there is demand
let me
for
stop you
Dino
there.
and also for Sam. I'll stop here by your order.
So let me move over to San-Ing, let me ask you a question here. So we're seeing all these changes in the marketplace. We're seeing winners, we're seeing losers. Obviously, that last speaker from Rockstar Capital, is buying real estate that originally cost 150 million. He's buying at $60 million at land value. I mean, I'm not going into that deal, but talk about, that last mile. Let's talk about, the surge in e-commerce. Let's talk about warehouses. Talk to us about cold storage. Talk to us about, what's the bright spot now? What has emerged since COVID, and more importantly, what actually happened faster as a result of that, because COVID pushed the market. So did key e-commerce get pushed 2 years down the line as a result of COVID? So express your interest on, again, cold storage, building cold storage, Amazon, pushing out into the marketplace, and all of the superstores asking for last mile. How does that transcend into family offices' portfolios?
Wow, you're embarrassing me, Matthew. I know nothing about those asset classes. But honestly, I think those are like Dino. I'm very much focused on workforce housing. Just it doesn't mean that storage is no good or others logistics is no good. I think a good GP can make money in any asset class, in any environment. So I won't dig too deep into those assets, but for me, just following the advice of our own book, we sort of gotten religion on a certain asset class, which is multifamily, stabilized multifamily, in the top 10 MSAs in America, Florida, Texas, as Kamil said, and we're just doubling down and going to try to buy another $1 billion worth in the next few years. Again, doesn't mean the other asset classes are worse. I think that you can make money in any asset class, which is very happy with multi.
Dino, pick up for us. So pick up on e-commerce, pick up on that surge on industrial, pick up on that, cold storage, last mile. Is that a place where family offices can continue to put their money?
Yeah, there's definitely demand out there from certain groups on that space, right? And if we talk macro a little bit, the e-commerce that drive, the need for last mile distribution space has been around well before the pandemic, right? It's been exacerbated during the pandemic, and I think there's still a runway for it. There's a school of thought that says that probably industrial rents are going to start easing off a little bit and headed south. I think we still have a little bit of runway even to get in the double digits in certain regions, even though Amazon has been backing out on some of their recently executed leases, and we have some dark spaces out there in certain packets around the country, which is a very interesting phenomenon. And these are rents, by the way, that they're very difficult to replicate. But overall, these high level themes you mentioned, Matthew, about e-commerce and last mile, and we all expect our Amazon delivery to be here yesterday, right? Forget about the 2-day window. That's a thing of the past. Now we're talking about same day delivery. Before you know it, it's going to be a few hour delivery, right? So omni-channel strategy is very important on the retail space, and we see that happening with Amazon with the acquisition of Whole Foods. That was a pure omni-channel play for them. They have, by the way, Amazon has storage facilities throughout Midtown, and if you don't know the buildings, you wouldn't even know they're even there, right? Like we're talking about proper Midtown, a couple blocks away from Grand Central. A number of those facilities that distribute your bananas, a couple of hours after you ordered it. So I think that's a trend that's going to continue happening, and there's definitely place in investors' portfolio for industrial. Nothing about one size fits all, but depending on your timeline, depending on your appetite for risk, happy to talk in detail about that. There's definitely space for that.
So Bill, I'm gonna swing back to you. This is sort of a 30,000-foot question. Let's talk about big box. Obviously the last speaker from Rockstep was talking about how to convert big box. So I'm thinking, should we take a big box and put it into self-storage? Should we make them hotels? Should we put them into apartments? What are you hearing from sort of, your group of how they're taking their assets instead of turning it into a BK situation and maybe repurposing it to self-storage hotels or apartments? What are you hearing out there?
Are you asking me?
Yes, please. Go ahead.
I'm sorry, I didn't realize that. The answer is, look, we're seeing in downtown LA and other metropolitan areas, hard for me to believe, but they're converting middle stories and high-rise office buildings into residential condos. That's a really expensive conversion. It's a statement by the people that own those buildings that they think it's going to be a long time before that office business comes back like it should. I'm not so sure. I'm an old-fashioned dinosaur. I'm used to walking out of my office and having my secretary there. There's a new acronym out called SOS. That's Secretary on Speed Dial. I'm sorry. I'm sorry. And what I'm not, nobody knows, but what I'm interested in, all these people that say, if you make me come back to work 5 days a week, I'm going to find another job. I want to see what they're saying in a year when unemployment is up again. Okay. And employers are going to start saying, show up or find another job. So I think that's going to change a lot. I do have, by the way, just another little pitch. One of my tools are people who are experts in repurposing real estate, because we think that's going to be one of the areas that's going to be big bucks.
Love that.
Big
Love
area.
that.
Yeah.
So Kamil, let me pick up on it, since obviously you've got your hand in the air. Bill brought up a really great idea. So let's just sort of kick this can a little bit more. JP Morgan, Morgan Stanley, Goldman Sachs, Credit Suisse, Jefferies, Telsa, all said in soft and hard messaging, we want butts back in the seats. Goldman said you either come back in your seat or you lose your job. Others have said no more can you live in Colorado and make New York wages. Jefferies wants employees back consistently. Do you think they're doing the right thing, even though they're going to be COVID compliant? Do you think this is the smart move? Do you think this is good for housing? Let's just sort of talk about these mandates of we want you back to work since Labor Day.
Two of the CEOs of the companies you mentioned are personal friends of mine, and I have called them to the face that they are hypocrites, because they were the ones who encouraged their employees to stay home. And now all of a sudden they want them back to work. People got accustomed to that virtual or hybrid lifestyle. They realized the saving of the cost of living by living in this style. And then they enjoyed something that Americans were always stripped of, spending family time, except for the weekend, except for Thanksgiving or whatever. Down in Europe, by our side, we take longer vacations, annual. Longer maternity than America, to tell you the truth. And you guys can verify this. What's happening now, Bill said that what's going to happen a year from now when the unemployment go up? Who told us that the unemployment reports today are correct? We're going to stay on real estate. I see you smiling now, Matthew.
You're doing great.
Come on. So what happened is back now to your conversation with Bill. Not every distressed sector of the commercial real estate can be retrofitted. Not every hotel can become apartments. I invested into extended stay because extended stay already has all the plumbing and the setup of a kitchen in one of the rooms or in one of the salons, the entry. But a regular hotel, to convert it, first of all, it will never pencil out based on the cost of the construction material, on the limited amount of labor, scarcity of labor. And also you are not going to find a lender who is going to do that tenant improvement. Tenant improvement is very, very critical when it comes to retrofitting buildings. Now you want to, this is limited. You and I know that. I am willing to finance and be a partner in a extended stay hotel, but not in a regular hotel. If I say, my first question is for a regular hotel, how old is it? Oh, it's 35 years, knock it down.
Got it.
It is more feasible, knock it down. The second component is what you call a big box. The big box, how many self-storages you're gonna make? Self-storage, I invest in self-storage. Self-storage need demand factor and need feasibility study. You need population. You need household income. You need a 3 miles radius, 5 miles radius, and 10 miles radius. That is not interrupted by railroad and highway or a river or a body of water. I mean, I don't mean to turn this into a classroom, but there is some reality that those talkers, they do not take responsibility for what they say. Just one more statement, and then I give you the timeout of basketball. The some of the big boxes you can convert. You can put a big gym. You can turn them into something else. But don't forget, there is a tax revenue for that town. The town was getting certain amount of taxes from having that mall. Now that mall is not there. You
Okay,
coming in,
so let me
you
switch.
coming
Let me-
in with
let
one
me-
asset. With one asset, it's not gonna work. But here is the last word. Here's the
Good.
last word. The best malls to invest in are the ones that have a grocery, because people today are spending more time home, cooking at home. Groceries today are on demand. The others, knock them down.
Okay,
Matt,
so
we got about 2
somehow
minutes, Matt.
we hang on.
Matt,
We
we got
got
about 2
JP
minutes.
Morgan, Morgan
Marty, we
Stanley,
asked for an extra hour.
and Credit Suisse to to mall. So let's just stay on point for one more second. So thinking about those office buildings, JP Morgan just built in New York City a $4 billion building, and the CEO came out and said, I want butts in the seats. So, saying you were talking about earlier in this week when we were all getting together about flexible leasing. Do you think there's any kind of a flexible leasing component in office buildings?
Yeah, in fact, I wanted to chime in. I'm going to address that question, but I want to make a plea to all the investors here, or the family office here. I think we're at a crossroads now where, as Dino said, we have an affordable housing crisis in this country. That's going to get worse because of supply chain issues. Supply is not meeting demand. And and then these mega trends of millennials getting married 10 years later, it's just getting worse. So I want to make a plea for more investors to come into this space to help solve this problem, and including, Matthew, in investing in flexible leasing and co-living, because as a feel-good measure, a lot of, in my view, again, I don't want to get into politics. In my view, a lot of societal issues today are actually tied to the breakdown of the American nuclear family. Mm-hmm. So half marriages, single moms and whatnot, living on their own. So having communal housing not only solve the supply issue, but it also actually brings together hopefully happier people. Right. So I don't want to go too sentimental, but putting all this together, I feel like not only is this an amazing opportunity for investors to help solve the crises, but hopefully taking this chance to even solve some societal problems.
Folks, we got 1 minute.
And we also have to.
Okay, so let me go back to Dino. Dino, I think something that family offices think about a lot is AI. Artificial intelligence. Artificial intelligence in their building, artificial intelligence in their leasing, artificial intelligence in picking out a good lender, artificial intelligence up and down the line. How do you see, in your practice, artificial intelligence changing the face of commercial real estate for the family office, the guy that's got, $50-60 million of assets under management, all the way up to, the family office, who I always look at as a mini institution? He's got $1 billion of assets under management. So talk about AI up and down a building and how it can really help, I think, bring in expenses for that family office or mini institution.
Yeah, there's a lot of disruption right now happening on that space, right? Talking about prop tech in general, billions and billions of dollars are being invested in that space. All the big institutions, or a lot of the big institutions out there, a lot of them you're very familiar with, like Brookfield, they're investing heavily in prop tech, right? You got VC money that collectively you have a lot of startups collectively being funded by the VC space. And I think it has a number of different applications, right? From reducing your construction costs to running your building more efficiently as far as operating expenses are concerned, all the way through title, leasing, even acquisition and due diligence, right? So there's definitely a lot of synergies there through AI. But closing a little bit on back on what Sam mentioned and a couple of minutes ago on the resi space, I think we also have to address the supply chain of the equation, right? The fact that we're not building nearly enough housing in the U.S., right? So no matter how we build, whether we build market or affordable or communal, that the problem is that we're not building nearly enough, and the problem for that is to a very large extent zoning related and NIMBYism related, right? And that's something that we collectively as a country need to address, and put in some heavy regulations on. We as developers, we have to be incentivized to go to a certain location and build a certain product instead of finding roadblocks, right? Whether that's a federal government solution or a local jurisdiction solution, we need to address that sooner than later. And I think that's going to be a huge way forward to address the housing crisis that we're living through today, which is to a very large extent driven by the supply constraint of good quality housing product, no matter what it is. I don't care if it's 1,000 square foot multifamily high-rise building, or a single family rental, or a communal facility.